All right, let's dive right into this explainer. Today, we're unpacking a really fascinating concept: how the economic storm we are facing right now mirrors a massive wealth building opportunity from exactly 50 years ago. Picture this: it's the 1970s, and America is sailing straight into the perfect financial storm. Inflation was absolutely surging, oil prices were exploding higher, and the economy was slowing down all at the exact same time. Now, for most people looking back, that period just meant stress, uncertainty, and drastically falling purchasing power. But for the people who truly understood what was happening beneath the surface, it created one of the biggest wealth-building opportunities of that entire era. And right now, as we look around in 2026, we're seeing a remarkably similar setup begin to unfold once again. You know the saying, history never repeats perfectly, but it absolutely rhymes. So what actually happens to your money when inflation, energy shocks, and global conflict all collide at once? Well, while most people look back at the 1970s and early 80s and just remember the economic pain, recessions, and financial fear, those who understood the flow of money experienced a massive transfer of wealth. You see, the absolutely crucial thing to remember is that in turbulent times, money doesn't just disappear, it moves. It aggressively leaves weak areas of the economy and flows directly into strong ones. It literally leaves the uninformed and goes straight to the prepared. If you can understand where capital is moving before everyone else catches on, well, that's exactly where the generational opportunity lies. Okay, let's get into Act 1, the rhyming cycles, the 1970s versus 2026. This comparison brilliantly illustrates that whole rhyming of history concept. Back in the 70s, we had massive monetary expansion, a major Middle East conflict, and a severe oil price spike. Fast forward to 2026, following the pandemic, we saw a massive wave of money creation and government spending that really fueled our current inflation problem. And we're once again seeing Middle East conflict adding new pressure to oil markets. So we're facing inflation concerns, energy concerns, and growing anxiety about the labor market. Only this time, the job market is facing an additional massive disruption because of artificial intelligence. Like we said, it's not identical, but the rhyming, it's undeniable. Let's look closely at how the dominoes actually fell back then. It's kind of like a giant puzzle. In 1971, President Nixon took the US dollar off the gold standard. This was a massive turning point, right? Because it gave the government and the Federal Reserve much more flexibility to just create money. And hey, in the short term, that feels great. But if too much money gets created relative to real economic output, you plant the seeds for inflation. Then, boom, in 1973, you get a major Middle East conflict that causes a huge spike in oil prices. Because oil impacts everything: transportation, manufacturing, food costs. Inflation skyrocketed. Finally, through the late 70s, the Federal Reserve responded by aggressively raising interest rates, which raised borrowing costs and really hit the job market. This specific domino effect created a brutal environment of inflation, high borrowing costs, and economic weakness all hitting at once. Which brings us to Act 2. The 10-year trap, a tale of three investors from 1971 to 1981. Let's actually gamify this data for a second to put it into perspective. We've got three different types of investors who each invested exactly $100 a month, or $13,200 total, over that volatile decade. Character number one is the S&P investor. They consistently put their money into the broader stock market through all the ups and downs. Over that 10-year period, their initial $13,200 grew to over $21,500. On the surface, that sounds pretty good, right? You put in a little over 13 grand, you walk away with over 21 grand. Next up, we have character number two, the saver. This person played it completely safe. They took that same $100 a month and kept it in the bank. Because interest rates eventually became incredibly high during that era, savings rates were way, way better than what we're used to today. Their cash actually grew to around $20,000. Again, not bad on paper. It felt safe, and they never had to sweat those big, scary drawdowns in the stock market. But wait, let's check out character number 3, the opportunist. This is the investor who actively looked for specific assets that could benefit from the chaotic environment. Let's look at gold, because gold was one of the biggest winners of that early inflationary phase. If that exact same $13,200 had been invested into gold, it would have ballooned to around $45,500 by 1981. I mean, wow. The opportunist completely crushed both the stock market and the savings account. But, and this is a massive but, there is a silent thief in all of this: the actual value of the money itself. Over that same 10-year period, inflation was surging at roughly 124%. So yes, the S&P investor and the saver made money in nominal dollars, but their cost of living rose even faster. In real purchasing power terms, they actually lost ground. Because of that insane 124% inflation hurdle, gold looked like the undeniable, undisputed champion of the decade. So you might be wondering, does the ultimate inflation hedge just keep winning forever? When people see a result like that, they naturally get very excited. They think, okay, problem solved, I'll just buy the inflation hedge and I win. And honestly, that right there, that's exactly where investors get trapped. They assume one fantastic decade makes an asset the ultimate long-term strategy forever. But if you don't understand what you own and why you own it, you can make a brilliant trade and completely ruin it by overstaying your welcome. Let's look at Act 3, the 20-year reality check, spanning 1971 to 1991. Okay, let's zoom out to a full 20-year horizon, assuming you kept investing that same $100 a month. Total inflation reached a staggering 236%. And get ready for a massive plot twist. Look at the S&P investor. By patiently holding productive businesses through all the fear, recessions, and volatility, their money grew to over $133,000. They absolutely crushed inflation in a meaningful way. The saver grew to $60,000. Better than nothing, sure, but still losing a huge amount of real value. But look at gold. The short-term superstar from the first decade ended up at $52,000. It literally fell all the way to last place, lagging even the safe cash in the bank. No way, right? So what exactly happened? Why did gold stall out so incredibly badly? Well, it comes down to understanding the absolute crucial difference between a productive asset and a hedge. A productive asset, like a really well-run business, innovates, it grows earnings, and it reinvests capital over time to compound wealth. Gold, on the other hand, is a hedge. It thrives on fear and loss of confidence in the system. When interest rates eventually rose and that systemic fear began to cool off, gold just completely stalled out. It proves for sure that there is no forever magic ticker. You just can't confuse a store of value with a true compounding machine. You've got to understand the specific role an asset plays in the broader economic cycle.
Now let's apply all of this to today. Act 4, the 2026 Wealth Playbook. If we are genuinely entering a new period of sticky inflation, elevated oil prices, high geopolitical tension, and slowing growth, we need to adopt that opportunist mindset right now, today. The modern opportunist isn't just randomly gambling. They're actively identifying which specific areas of the economy are positioned to gain from these exact pressures. Think about it. When energy prices spike, it's the energy producers, pipelines, and oil services that benefit. When geopolitical conflict rises, defense contractors and cybersecurity firms step up. When supply chains get tight, the companies controlling critical bottleneck resources gain immense pricing power. And then, of course, there's AI. Instead of chasing the shiny consumer hype and the obvious names everyone's talking about, the real opportunist in 2026 studies the physical backbone required to actually power the AI revolution. We're talking semiconductors, the massive data centers, the intense power demand, and the cooling systems. Because regardless of which consumer app ultimately wins, that underlying infrastructure still has to be built. Listen, the absolute biggest mistake you can make right now is chasing whatever is hot on social media or trending in the headlines. Buying in out of a pure fear of missing out, FOMO, and then panic selling the second volatility hits, that is not investing. Actually, scratch that. That's just an emotional reaction disguised as investing, and it will rapidly drain your wealth. True investing requires discipline, deep research, and really understanding exactly what phase of the cycle we're in. You have to ask yourself, where is the demand non-negotiable? Where is supply constraint? Study the money flow. Don't blindly buy the hype. So, what kind of investor are you going to be? At the end of the day, the big takeaway from 50 years ago isn't that one magical asset always wins. It's that different environments wildly reward different behaviors. The shift happening around us in 2026 is another massive test. Fear is going to dominate the average person, while preparation is going to reward the disciplined. The financially educated are using this rare window to separate themselves from the crowd right now. So the final question I want to leave you with is this. Will you let inflation quietly tax your hard-earned money, or will you use the lessons of history to build true generational wealth?